Welcome to the Explainer. Okay, let's just dive right into this today with a pretty massive question. If I were to ask you right here, right now, to invest your money in India's top 50 companies, the Nifty 50, what would you choose? Would you pick an ETF, or would you go with an index fund? Just take a second to really think about it, because most people, when they're actually faced with this choice, will just kind of shrug and say something along the lines of, well, aren't they exactly the same thing? And you know what? Hold on to that thought, because that right there brings us to our very first major roadblock, and honestly, a misconception that could be secretly draining your wealth as we speak. We really have to address this head-on, because believing that ETFs and index funds are identical is perhaps the single biggest misunderstanding in the investing world today. Look, yes, absolutely their ultimate goal is the same. They both want to follow the Nifty 50. But when you look underneath the hood, the hidden differences between these two are just staggering. We're talking about differences that directly impact your returns, your daily convenience, and over a long timeline could potentially cost you lakhs of rupees in lost wealth or hidden fees. Seriously, you might have been running a monthly SIP for years, completely unaware that you actually chose the absolute wrong product for your specific lifestyle. Or maybe, you wanted the flexibility of an ETF but accidentally ended up locked into an index fund. The cost of this confusion is incredibly high. But to understand how to fix it, we first need to make sure we understand the game we're actually playing.
So before we uncover those hidden costs and fees, we really have to ask, what exactly is the playing field here? You see, to make the right choice between these two vehicles, we first need to completely understand the destination they are both driving toward. I mean, you can't choose your ride if you don't even know where you're going, right? So let's clear up exactly what the Nifty 50 is, because surprisingly, a lot of seasoned investors still get this fundamentally wrong.
The definition of the Nifty 50 itself is where all this confusion usually starts. Let's say you want to invest in India's absolute top companies: Reliance, HDFC Bank, Infosys, TCS, ICICI Bank, L&T, the whole shebang. The Nifty 50 index is simply a combined tracking list of those top listed companies. That's it. It is not a company itself. You cannot go out and buy a share of Nifty Inc. Think of it exactly like the IPL points table in cricket. You literally cannot buy the IPL points table, right? It's just a ranking system. The actual players and the franchise teams are separate. It's the exact same thing here. The Nifty is just a ranking index. The actual companies make up that index. And because you cannot buy the Nifty directly, you need a specific financial vehicle to take you there. And that brings us to the ultimate crossroads of today's explainer.
So here are two choices to get to that final destination. Both options have the exact same core goal: buying those top 50 stocks in the exact same proportion. If the Nifty goes up 5% this year, both of your investments should theoretically go up by roughly 5%. But the journey to get there, completely, totally different. Think of an index fund like taking a train. It's highly scheduled, it's a completely automated journey. You get on, you sit back, and you just relax. Now on the right side, the ETF is a lot more like taking a flight. It's dynamic, the pricing changes by the literal minute, and you have to manually book it and navigate the market yourself. The booking process, the flexibility, and most importantly, the costs are worlds apart. So which one is actually better for you? Well, let's start by unpacking that flight.
Section 1. Unpacking the ETF, or Exchange-Traded Fund.
People often call this the ultimate combination of a mutual fund and the share market, and for good reason. The absolutely crucial point is right there in the name: exchange-traded. It trades on the stock exchange, exactly like a regular individual share of Reliance or TCS. Literally, from the moment the opening bell rings at 9:15 a.m. until the market closes, the price of an ETF changes every single second based on the live market. Let's say it's 250 rupees in the morning, dips to 249 by lunch, and then spikes to 255 by the evening. If you're sitting there, you see the market randomly crash at 11:30 a.m. and you think, wow, this is an incredible buying opportunity, you can instantly hit buy on your app, and boom, those units are in your account. That instant execution is absolutely its superpower. Assuming, of course, you don't panic sell by lunch. But listen, to use this superpower, you absolutely must have a demate and trading account. We're talking brokers like Zerodha, Grow, or Upstocks. You cannot buy this through a basic standard mutual fund app.
Now, instant buying probably sounds like a total dream, right? But hold on, because there is a massive hidden pricing trap waiting for you right here. One that catches almost every new investor totally off guard. You see, the live market creates a totally different pricing dynamic, and you desperately need to understand it before you ever hit that buy button.
The really crucial point here is the difference between NAV, which stands for net asset value, and the actual trading price on your screen. The NAV is the true, mathematically calculated underlying value of the Nifty 50 stocks inside your ETF. Let's just say mathematically, the NAV is exactly 250 rupees. But because an ETF trades like a stock, its live price is entirely driven by human supply and demand. If the market is super bullish today, everyone's excited, and everyone is rushing to buy the ETF. That crazy high demand pushes the trading price up to, say, 251 rupees and 20 paise. What does that mean for you? It means you are buying the ETF at a premium. You are literally paying slightly more than its actual worth. And conversely, during a market panic, you might actually get it at a discount. This constant second-by-second fluctuation requires you to be sharp. If tracking live premiums and discounts or endlessly refreshing your brokerage app on your lunch break sounds exhausting to you, well, then you are going to absolutely love our next option.
Section 2. The Index Fund Approach. If the ETF is for the active trader who just loves watching the market tick up and down, the index fund is the peaceful, quiet sanctuary for the investor who just wants to build wealth without the daily stress. It is a standard, straightforward mutual fund that simply copies an index. It is, quite literally, the ultimate set-it-and-forget-it tool. Here's how simple it is. Step 1, you decide your monthly SIP amount, say 5,000 rupees. Step 2, you set up an auto-deduct mandate from your bank account. Step 3, you close the app and let it grow automatically. That's it. You don't need to check if the market is up or down today. You don't need to worry about market hours or opening bells. And honestly, the best part? You don't even need a demat account. Zero. You can do this straight from any standard mutual fund app or directly on the AMC's website. It is designed from the ground up for pure, unadulterated convenience. But, as always, this convenience comes with a very specific rule about pricing that you really need to be aware of.
Here is exactly where the index fund completely diverges from the ETF. Let's say it's 10 a.m., you see the market is down significantly, and you quickly transfer 10,000 rupees into your index fund. By the end of the day, the market shoots back up 2%. You're sitting there probably thinking, awesome, I timed it perfectly. I bought at the absolute bottom. But, surprise, you didn't. Why? Because index funds literally do not care what time of day you hit the button.
With an index fund, all buy and sell requests made throughout the entire day are batched together at the end-of-day NAV. You do not get that live market price at 10 a.m. Instead, units are allotted to you based on one single unified closing price calculated at the very end of the day. Everyone gets the exact same price, regardless of what time they place their order. Now, you might be thinking, is this a disadvantage? Well, not necessarily. If your goal is to build wealth over 15 or 20 years, capturing a tiny 1% dip at 10 a.m. on a random Tuesday in November means absolutely nothing in the grand scheme of things. It actually forces you to stop trying to time the market. But now that we understand exactly how both of these vehicles operate under the hood, it is time to put them in the ring together and see what happens.
Section 3. The Ultimate Matchup. Let's see who wins.
When we put them head-to-head like this, they systematically trade blows. First up, expense ratio, the annual fee you pay the fund manager. ETFs generally win this hands down. An ETF might charge a tiny 0.15%, while an index fund might charge double that at 0.30%. And over 25 years, trust me, that tiny percentage difference compounds into a massive amount of money. Next row, liquidity. If you want instant cash during market hours, the ETF wins again, allowing instant buying and selling, whereas the index fund, as we just learned, makes you wait for that end-of-day price. But keep looking at the next rows. SIP convenience? The index fund absolutely destroys the ETF here. The index fund is fully automated, whereas with an ETF, you usually have to manually log in, check the price, and buy units every single month. Finally, demat required? Index fund wins again, requiring 0 complex accounts. So looking at the board, on paper, it's basically a dead tie. 2 points for the ETF, 2 points for the index fund. So how on earth do we break the tie?
With a perfectly tied score, the real winner actually depends on a highly overlooked factor. Everyone obsesses over the expense ratio. They obsess over whether they need a trading account, but they almost always forget to check the one single hidden metric that actually determines if they are getting what they paid for in the first place.
That metric is called the tracking error. Let me explain this because it's absolutely crucial. Both the ETF and the index fund promise to copy the Nifty 50, but they aren't perfect clones. Tracking error is a metric that shows exactly how accurately a fund copies its actual index. Think of it like a driver trying to stay perfectly in the center of their lane on the highway. The tracking error measures how much they randomly drift left or right. A lower tracking error means the fund is doing a fantastic job mirroring the index. A high tracking error means they are drifting, and that drift literally eats into your long-term returns. Before you ever invest your hard-earned money in either an ETF or an index fund, you must look up its historical tracking error.
Lower is always better. But even armed with this technical knowledge, you still have to make a final choice. So let's figure out exactly which one belongs in your specific portfolio.
Section 4. Finding your perfect match.
I promised at the start that you wouldn't need a fancy financial advisor by the end of this explainer to decide what to do. So, let's look at Profile 1, the beginner. This is someone who has a salary coming in every month and just wants to quietly, consistently start investing maybe 2,000 to 5,000 rupees a month. They do not have the time or energy to stare at stock charts during office hours. They have zero market experience, and they definitely don't have a demat account set up yet. For this profile, the undisputed, hands-down winner is the index fund. Why? Because it puts your entire wealth creation on autopilot. You set up your SIP once, and the train does all the rest of the heavy lifting while you just go live your life. It's simple, it's clean, and it is highly effective. But what if you aren't exactly a beginner?
Now let's look at Profile 2, the experienced pro. This investor already has a Zerodha or Grow account fully active. They actively follow financial news. When the market crashes by 3% on a random Thursday, they don't panic and sell. They get super excited. They love manually buying into those market dips, and they demand the absolute lowest expense ratios available on the market. For this investor, the winner is clearly the ETF. It literally gives them the steering wheel. They can navigate the market in real time, leverage live pricing, and execute their strategy flawlessly. But hold on, because there is a third profile, and honestly, this is where the absolute biggest secret of long-term investing hides.
Profile 3 is the 20-year wealth builder. This is the person whose one and only goal is to amass serious, life-changing wealth over the next 2 decades. And for this profile, the ultimate truth is going to surprise a lot of finance nerds out there. Because for the 20-year wealth builder, the secret weapon isn't the product at all.
The golden rule of investing is profoundly simple. Perfect habit is more important than the perfect product. Look, saving 0.15% on an ETF's expense ratio is mathematically great. Of course it is, but it is completely and utterly useless if you lack discipline. If you choose an ETF but then you forget to log in and manually buy your units for 3 months because you are busy with work or life, you have lost more money in missed market growth than you ever would have saved on those tiny fees. On the flip side, the person who chooses the slightly more expensive index fund but lets that automated SIP run uninterrupted for 20 straight years without ever panic selling, that is the person who will actually build immense wealth. Consistency beats optimization every single time. So, as we look ahead to 2026 and beyond, I have to ask you, which profile are you really? Are you the beginner who needs the automated, stress-free piece of an index fund? Are you the pro who wants the precision, real-time control of an ETF? Or are you the wealth builder, finally recognizing that your daily, consistent habits matter so much more than the vehicle you happen to choose? Remember, both of these vehicles lead to the exact same place, the Nifty 50. Both of them can absolutely make you wealthy. The only difference is the journey you take to get there. So reflect on your own habits, figure out what you will actually stick with when things get tough, and make your choice. Drop a comment below with which profile fits you best, stay consistent, and keep growing. Thanks so much for joining me on this explainer.